Hey, I'm Ben from Modern Graham, and today we are going to talk about Bank of America Corp. So be sure to stick around to know what I think of this company. So we have Bank of America Corp. The ticker is BAC. Current price is 36.08, and of course the sector is financial services. And it is, surprise, surprise, a bank. So anyway, balance sheet. These are the figures that are most important to the valuation. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. They will all come into play while doing this valuation. Over here, we have the graph that shows earnings and dividends. You can see that this one, Bank of America, did really great leading up to the Great Recession. And then, of course, it had a whole bunch of trouble at that time. And since then, it has risen back up. But unlike some companies we've looked at recently, it has not gotten back to its pre-recession levels. So that is, of course, very interesting. And looking at the detail over here, we can see that we had a couple years of negative earnings in there, but not too many the rest of the way. And EPS MG is a weighted average of earnings per share. So that can help smooth out some of the business cycles. So I take 5 years of earnings, put the most weight on the current year and the least on 5 years ago to get that weighted average. And you can see even that has not quite gotten back up to its pre-recession level. So that is very interesting about this one. Now, dividends, they have had a solid dividend for over 30 years, which is very good, even in light of their terrible earnings during the Great Recession. They still paid some dividends. So they do have a lot of emphasis on keeping that dividend out there. Unfortunately, during that Great Recession, they really cut that dividend. They were paying $2.40 in 2007, and they cut that all the way down to 4 cents, which they kept for 5 straight years. And they have not even gotten anywhere close to where it was before. It's only a third of the dividend that they paid in 2007. Dividend growth, you can see, like I said, they were growing at about 10 or 20% for a while, and then they cut it, and they've been growing it significantly each year, but not the last couple of years, probably due to the pandemic, but they probably could have been rising that even more. Dividend yield it was very steady at 3 or 5%, but now it has been 1 or 2% since then. Dividend payout ratio, again, it used to be 40 or 50%, but now it is back down to 20 to 40% at most. So that is interesting that they have returned these, but that dividend level, you can see here in the chart again, red is nowhere near what it was before. Stage 1, is this company suitable for the defensive investor or enterprising investor? Let's keep in mind the difference between those two. The defensive investor is not willing to do extensive research. So they have these 7 tests that a company must pass to get to be considered. And the enterprising investor is willing to go a further step, so their tests are not as stringent. So defensive investor, market cap has to be over 2 billion. Of course, it passes that. Current ratio has to be over 2. It passes that. Positive earnings per share for 10 years, passes that. Dividend for 10 years, yes, because technically it did pay a dividend in 2012 and 13, even though it was very small compared to today. Increase in earnings of a third over the last 10 years, it passes that. And PEMG under 20, it passes that. Price to book ratio under 2.5, it passes that. It gets a perfect score of 7 for the defensive investor, and by default then it is suitable for the enterprising investor. Now, it also passes all 5 tests. If you're liking this, be sure to take a moment to like the video, subscribe to the channel, and download the free valuation calculator. The link is in the description and the comments below. Stage two is a determination of intrinsic value. So we have to take a look at this and figure out value is independent of price. A company could have a price higher than its actual value or below its actual value. It's like anything that you buy. You can buy something on sale and pay less than what it's worth, or you can overpay for something and do that. But anyway, we have to figure out the value. And how we do that is we use a formula given by the great Benjamin Graham in his book, The Intelligent Investor. And Benjamin Graham, if you don't know, he was the teacher of Warren Buffett, the greatest value investor of all time. So value equals earnings per share times 8.5 plus 2 times the growth rate. I've modified that by taking the weighted average of earnings to help have a little bit smoother value formula or value calculations as well. And so we have two variables to calculate, earnings per share and growth. Let's do that. Earnings per share, again, I take the weighted average of the last 5 years, putting the emphasis on the current year. So we get 294. Taking that and the earnings per share weighted average from 5 years ago, we get a total growth between those two of 64.55%. Divide that by 12, you get an average growth per year of 12.91%. And then we have a safety margin here because growth is a key variable in this formula. If you overestimate growth, you very easily can swing that value way up or way down. And so it's good to have the safety margin there. Growth estimate we get then is 9.68%. And then we put those into the formula and we get a value of 81.93, which is higher than the current price. And down here you can see the current price is 36.08, and that is only 44.04% of the value, so it is therefore undervalued. The net current asset value, that is significantly negative, so that is a floor that doesn't really apply today. The modern Graham value based on 3% growth is 42.63, and based on 0% growth, it is 24.99. So if you put price in for value and solve for growth, you find that the market is implying a growth rate of 1.89%. Now, looking at the grade, if a company gets 2 points for being suitable for the defensive investor, 1 point for being undervalued, 1 point for trading below its Graham number, 0 for its dividend growth, half a point for its dividend yield, and half a point for trading below its industry average price to earnings, for a total score of 5, which is an A grade. Stage 3 is further research. So if you've determined that it is suitable for your investor type and that it is undervalued, the next step is for you to look at your individual portfolio and investing goals to determine if it is a good fit for your portfolio. So you need to do further research to do that. Net current asset value formula can be useful for that sometimes, but not in this case because it is negative. That would be a liquidation value if you're not familiar with it. But yeah, anyway, Graham number formula. That is a number that has been derived from many of the defensive investor requirements, and it's another way that people look at a company to see if it would be undervalued. Here it is 46.59, which is higher than the price, so it might be another indicator that it is undervalued. PEMG, like I've said, is 12.27. Current ratio is 2.16. Price to book ratio is 1.2. Dividend yield is 2.38%, and 9 years of dividend growth. Moving on to stage 4. So if you've determined that it's a good fit, then it is time to try to get the timing right because you want to maximize your profit by getting your entry point at a good spot. And looking at the chart, this is the daily view here. We've got resistance and support levels that right now it is really testing one at this point. If it falls through, if it cannot stay above that, then it might come back down to 31. But if it can stay above there, it has potential to make it up to 43 before having a major resistance level there that goes back over here. This one goes way back even farther if we switch to the weekly view, I believe. Yeah, it was kind of, I'm making it a little bit wider here, but it had space there, or like hit that and there, and hit here. So this is a pretty significant one at 30 cents. Going up to 43, hit it there, and I think, yeah, going farther back, it hit it a few times back in the early 2000s. So it is interesting here to see what will happen and see if it can stay above that and have potential to rise further. But anyway, that is it. I hope you enjoyed this. Be sure to click on the video on the screen now for another great valuation. Thanks for watching, and I will catch you next time. Take care.